For nearly 100 years, every time Wall Street is broken, it is eventually healed. The crash of 1929 wiped out almost 90% of the Dow's value, and yet the market found its footing again. The oil shocks and stagflation of the 1970s strangled stock returns for a decade, and yet the market found its footing again. The financial crisis of 2008 erased trillions of dollars in a matter of months, and yet the market found its footing again. The COVID crash of 2020 was the fastest and most violent decline in modern history, and the market recovered in a matter of months. Every generation has lived through a moment when it felt like the system was breaking for good, and every generation has watched the system put itself back together. That pattern is so consistent, so deeply woven into modern life, that most people have stopped thinking of it as a pattern at all. They think of it as a law of nature, as certain as gravity. Stocks go down, and then stocks go up. But what if that law had an exception? And what if we are closer to it than anyone wants to admit? What if the next crash simply never ended? Meet Daniel, a 34-year-old software engineer living outside Denver, Colorado. His wife, Priya, works as a physical therapist at a regional hospital. They have 2 kids, a mortgage they refinanced at what felt like a great rate, and a joint retirement strategy they built together over the past decade. Mostly index funds inside a 401k, a Roth IRA on the side. The kind of boring, sensible plan that every financial advisor on the internet tells you to follow. They are not wealthy. They are not reckless. They are the exact kind of household that the entire modern retirement system was built around. People who trust that if they keep contributing every month and keep their money in the market, time will do the rest. Daniel has read the statistics. He knows that historically the market has always come back. He has told himself more than once that even a brutal crash is just a buying opportunity if you're young enough to wait it out. That belief has quietly underwritten every financial decision he has made for 15 years. Then on a Tuesday that starts out completely unremarkable, cracks begin to show. It isn't one dramatic headline, it's a string of them. A major regional bank freezes withdrawals after a wave of bad commercial real estate loans finally catches up with it. A handful of heavily leveraged tech companies, the kind that were propped up for years by cheap borrowing and investor enthusiasm, missed debt payments in the same week. Consumer spending data comes in soft for the 3rd month running. None of it feels like a single catastrophe. It feels like a slow leak, but slow leaks compound. Within a month, the S&P 500 is down 18%. Within 2 months, it's down 30%. Analysts on financial television keep repeating the same reassuring lines people have heard in every downturn since 1987. This is a correction. Corrections are healthy. Don't sell into the panic. Time in the market beats timing the market. Daniel repeats those lines to himself too, mostly because he needs them to be true. Except this time, the recovery doesn't come. Instead, something starts happening that nobody on financial television wants to say out loud. The economy underneath the market starts breaking too, not just the prices on a screen. Manufacturing orders dry up, freight volumes fall off a cliff, which is usually one of the earliest and most honest signs that the real economy is slowing, because trucks don't move goods that nobody's buying. Credit tightens. Banks that spent the last 2 years already nervous about their balance sheets start pulling back on lending to small businesses, the same way they did in 2008, and in a much more drawn-out way, the way Japanese banks did after their own bubble burst in 1990. Small businesses that could normally borrow to bridge a rough quarter suddenly can't get a line of credit at any reasonable rate. Layoffs start in tech, then spread to retail, then to logistics, then to construction. Unemployment claims tick up every single week for months, not in a dramatic spike, but in a grinding, relentless climb that's almost worse because it never lets up. A year passes. The market is still down. 18 months pass. It's down further. 2 years in, the market has lost nearly half its value from the peak and shows no sign of a real, durable turn. This is the part of the story where, if this were any other crash in modern American history, the tide would already be coming back in. The COVID crash took about 4 months to fully recover. Even the 2008 crisis, one of the worst in a century, saw the S&P 500 bottom out in March 2009 and begin a real climb from there, even though it took over 5 years to reclaim its previous high on a straight price basis. What Daniel is living through doesn't behave like that. It behaves like something slower and stranger, something that starts to remind financial historians of a very different kind of event. They start pointing to Japan. In December 1989, the Nikkei 225 hit an all-time high near 38,915, riding the tail end of one of the most extreme asset bubbles in modern history. A bubble so large that, at its peak, the land underneath the Imperial Palace in Tokyo was theoretically worth more than the entire state of California. Then Japan's central bank started raising interest rates to cool things down, and the bubble didn't just deflate, it collapsed. By August 1990, the index had already been cut in half. It kept falling, with brief rallies that fooled people into thinking the bottom was in, followed by fresh lows for years. By 2003, more than 13 years after the peak, the Nikkei bottomed out around 7,862, roughly 80% below its all-time high. It took until 2024, 35 years after the original peak, for Japanese stocks to finally reclaim their 1989 level. An entire working generation of Japanese savers put money into the market for their retirement and watched it go nowhere, or worse, for their entire careers. Wages stagnated for decades. Japanese banks, propped up rather than allowed to fail, became what economists started calling zombie banks, technically alive, but incapable of fueling new growth, quietly extending credit to zombie companies just to avoid recognizing the losses on their books. Japan didn't experience a depression in the dramatic breadline sense. It experienced something slower and, in some ways, more corrosive, a prolonged stall that sapped confidence out of an entire economy for a generation. The comparisons don't stop with Japan. Historians dig up the 1973 to 1974 bear market in the United States, when the Dow started the period at just over 1,000, and by December 1974 had fallen to 616, a decline made worse by the OPEC oil embargo, Nixon's resignation during Watergate, and inflation running above 12% at the same time. Stocks were collapsing, a brutal combination now called stagflation because it broke the normal rules where inflation and recession were not supposed to happen together. That crash alone would have been bad enough, but the entire decade that followed was, in real terms, a lost decade for American investors. The Dow essentially went nowhere in nominal terms from 1970 to 1980. And once you adjust for inflation, the S&P 500 actually lost close to half its real value over those 10 years, even with dividends reinvested. An entire cohort of investors who bought stocks at the start of the 1970s spent the whole decade underwater in terms of real purchasing power. Even the Great Depression, the crash everyone thinks of first, is more complicated than the popular version. Yes, the Dow peaked at 381 in September 1929 and didn't reclaim that nominal high until November 1954, a 25-year gap that gets repeated constantly. But dividend yields back then were enormous, sometimes near 14% during the worst of the crash. And once you account for reinvested dividends and the deflation of the early 1930s, some analysts argue the real recovery for an investor who held on took closer to 5 to 10 years rather than 25. Still bad. Still brutal for anyone who needed the money on a normal timeline. But not quite the horror story people imagine when they hear 25 years. Daniel doesn't know all of this history off the top of his head, but he starts learning it fast, the way people always do once the abstract becomes personal. What he does know, viscerally, is what's happening to his own accounts. His 401k, which had crossed six figures for the first time just before the crash began, a milestone he and Priya had celebrated quietly over dinner, is now worth less than half of that. He logs in one night and just sits there looking at the number, doing the math on how many more years of contributions it would take to simply get back to where he already was 2 years ago, let alone where he needs to be by 65. This is not an abstract fear for Daniel. It's shared by an enormous number of people even before any hypothetical mega crash. Recent surveys of American retirees found that the typical person believes they need somewhere around $800,000 saved to retire comfortably, while the average retiree actually has less than $300,000, and nearly 3 in 10 retirees report having no retirement savings at all. Almost 2/3 of retirees surveyed said outright that they believe the country is in a full-blown retirement crisis. And fewer than half believe retirement will even be realistically possible for the typical American a generation from now. The median 401k balance across millions of real accounts, even during a period of strong market performance, sits at a small fraction of the average, because a small number of very large accounts skew the picture. The typical working household simply does not have anywhere close to enough, saved, crash, or no crash. Layer a Japan-style, multi-year collapse on top of that already fragile foundation, and you don't get a temporary scare. You get a structural collapse in the entire idea of retirement as most people currently understand it. Priya starts to see a parallel version of the same story from inside the hospital system where she works. Capital projects that had already been approved, a new outpatient wing, an upgraded imaging center, quietly get shelved because the hospital's endowment and investment portfolio, the same kind of long-term stock holdings that fund almost every large institution in the country, have taken a huge hit. Hospital systems, universities, and nonprofits all rely heavily on their invested endowments to fund expansion and operations. And when the market falls and stays down, those institutions don't just lose paper wealth, they lose the ability to hire, to build, to expand access to care. This mirrors, on a smaller scale, exactly what happened to Japanese banks and corporations during the lost decades. When the collapse in asset values didn't just hurt shareholders, it froze the entire machinery of lending and investment that a modern economy depends on to keep growing. When the assets backing an institution's future plans lose half their value and stay there for years, every plan built on top of those assets gets frozen or canceled. The freeze spreads outward from big institutions into the small, scrappy parts of the economy that usually drive the recovery in any normal downturn. In a typical recession, venture capital and private investment pull back for a while and then come roaring back, funding the next wave of companies that eventually pull the whole economy forward, which is more or less what happened after the dot-com bust and after 2008. But in Daniel's world, that rebound keeps getting postponed. Startup funding, which even in ordinary downturns can fall by 50 to 60% in a single year as investors get spooked and pull back toward safer bets, doesn't recover on the usual 18 to 24-month cycle. It just keeps shrinking quarter after quarter because the institutional investors who supply venture funds with capital, pension funds, endowments, insurance companies are themselves nursing enormous losses and have no appetite for risk. Historically, more than half of venture-backed startups shut down within a few years of a serious funding drought, and the founders who survive usually do it by bootstrapping, cutting costs to the bone, and simply outlasting the winter. But winters are supposed to end. In this scenario, the winter doesn't end on schedule, and the next generation of companies that would normally have emerged from the wreckage of the crash to reinvent the economy, the way real innovation cycles historically have, simply doesn't show up on time. That absence matters more than almost anything else in this story, because it points to the actual mechanism connecting a stock market crash to a real, lasting economic depression. A stock market, on its own, is just a pricing mechanism. It doesn't grow food, build cars, or cure diseases. What it does is allocate capital, funneling savings toward the businesses and ideas that investors believe will be productive in the future. When that mechanism seizes up for an extended period, the damage isn't really about the number on a brokerage app. The damage is that new hospitals don't get built, new factories don't get funded, new medicines don't get the capital they need to clear expensive clinical trials, and new companies that might have employed millions of people simply never get formed. This is the deeper, quieter version of the Japan story. Japan didn't just suffer falling stock prices for 3 decades. It suffered declining productivity growth, wages that were still lower in real terms in the 2010s than they were in the late 1990s, and a shrinking share of the world's largest companies. In 1989, 32 of the world's 50 most valuable companies were Japanese. By the late 2010s, only one remained on that list. That is what a lost generation of capital allocation actually looks like from the outside. Not a single dramatic collapse, but a slow fading from relevance. Back in Colorado, Daniel and Priya start feeling the second-order effects that always follow a crisis like this, the ones that don't show up immediately in the headlines. Local governments, whose budgets are quietly propped up by the investment returns on massive public pension funds, start facing their own reckoning. Even before any hypothetical mega crash, American state and local pension systems were already sitting on well over $1 trillion in unfunded liabilities. The gap between what has been promised to retired teachers, police officers, and other public workers, and what has actually been set aside to pay for it. Public pension systems have never fully returned to the funding levels they had before the 2008 financial crisis, even after more than a decade of one of the strongest bull markets in history, with the average funded ratio stuck stubbornly around 80%. Now imagine that same shortfall after a crash that doesn't just dip and recover, but stays down for years. States and cities would either have to raise taxes sharply, cut services, or both. Exactly the kind of scenario that has already forced some municipalities, like Stockton, California, into outright bankruptcy after their pension math stopped working. Daniel's own property taxes and the quality of the local schools his kids attend are quietly tethered to a stock market he doesn't control and can no longer count on. As the third year of the downturn grinds on, a psychological shift starts to take hold that economists have a name for, even if most people have never heard the term, the paradox of thrift. When individual households, worried about their jobs and their shrinking retirement accounts, all respond rationally by saving more and spending less. The combined effect of millions of people making that same sensible choice at the same time is to shrink the overall economy, because one person's spending is another person's income. Restaurants see fewer customers and cut staff. Retailers delay reopening stores and lay off workers. Those laid off workers cut their own spending further, and the cycle feeds itself. It's the same self-reinforcing spiral that deepened the Great Depression in the 1930s, and that central banks around the world have spent the better part of a century trying to design tools to break. Central banks in this new crisis try everything in the modern playbook. Interest rates get cut towards zero, then held there. New rounds of asset purchases, the kind of quantitative easing first deployed at scale after 2008, get rolled out to try to force money back into the economy. Government stimulus checks go out. Infrastructure spending gets fast-tracked. Each of these interventions produces a brief rally, a few good weeks where it looks like the corner has finally been turned. And each time the rally fades because the underlying problem, a collapse in confidence itself, is not something you can fix purely with a lower interest rate. Japan discovered exactly this limitation decades earlier, when economists like Paul Krugman pointed out that the country had fallen into what's called a liquidity trap, a situation where interest rates are already so low that cutting them further does almost nothing to get people and businesses to borrow and spend again, because the problem isn't the cost of money, it's the complete absence of confidence in the future. Daniel starts asking himself the same question that anyone living through a period like this eventually asks. If the stock market isn't reliably going to make his family's money grow anymore, what's actually supposed to do that job? It's a more interesting question than it first appears, because it forces you to separate two things that get treated as identical in ordinary times: the stock market and the real economy. They are related, but they're not the same thing, and history is full of moments where they diverge sharply and for long stretches of time. A rising stock market is supposed to reflect real productive growth, businesses becoming more efficient, new technologies expanding what's possible, workers producing more value per hour worked. But a stock market can also rise on pure speculation, detached from anything happening in factories or laboratories, the way Japanese land and stock prices did in the late 1980s, when the entire property under the Imperial Palace was briefly worth more than the whole state of California on paper, a number that had nothing to do with any real productive capacity and everything to do with a self-reinforcing belief that prices would keep going up forever, right up until they didn't. That distinction becomes the thread Daniel starts pulling on, almost as an act of self-preservation. If real prosperity, the kind that eventually shows up in stock prices too, comes from somewhere other than the market itself, then maybe the market's failure to recover isn't a story about markets at all. Maybe it's a story about whether the underlying economy is still capable of producing genuinely new value. And there, buried in the middle of years of bad news, something starts to shift. It doesn't come from a stimulus package or a Federal Reserve announcement. It comes from the same place real recoveries have historically come from every single time: a slow accumulation of actual technological and productive progress that eventually becomes too large and too obvious for capital to ignore. In this version of the future, its advances stacking up in fields like artificial intelligence-driven manufacturing, next-generation energy storage, and biotechnology, the same kinds of frontier industries that, in the real world, have already begun reshaping entire sectors of the economy well before any hypothetical crash. Companies that survived the funding drought by staying lean, the ones that didn't burn through cash chasing growth for its own sake, start showing real, defensible profits instead of just growth stories. A small number of them start attracting capital again, cautiously at first, from investors who have spent years sitting on the sidelines and are desperate for somewhere productive to put money that isn't just sitting in cash, losing value to inflation. It isn't a flood, it's a trickle. But trickles, sustained long enough, eventually become rivers. This is, historically, exactly how every real recovery has actually started, whether people realize it in the moment or not. It wasn't a press conference that ended the Great Depression. It was years of underlying industrial buildup, some of it tragically tied to the mobilization for the Second World War, that finally put idle capital and idle labor back to productive use. It wasn't a single policy that pulled the world out of the 2008 financial crisis. It was years of quiet deleveraging inside households and banks, combined with genuine technological shifts in mobile computing and cloud infrastructure that eventually gave investors something real to believe in again. Even Japan's slow, decades-late climb back to its 1989 peak by 2024 wasn't really about the stock index itself. It came alongside actual corporate governance reforms that forced Japanese companies to stop hoarding cash and start using capital productively again, alongside a genuine, hard-won return of modest inflation after a generation of paralyzing deflation. The lesson underneath every one of these stories is the same, and it's the lesson Daniel eventually arrives at from his kitchen table in Colorado, staring at a retirement account that took years longer than anyone expected to start climbing again. The stock market doesn't create prosperity out of nothing. It's a mirror. It reflects whatever is actually happening in the underlying economy, sometimes with a long, painful delay, sometimes amplified by fear or greed far beyond what the fundamentals justify, but always, eventually, tethered back to reality. When people stop inventing, stop building, stop taking the kind of long-term risks that turn ideas into companies and companies into jobs, the mirror shows a flat, dead reflection, and no amount of stimulus or interest rate cuts can force a reflection to move on its own. When people start building again, even quietly, even before anyone announces the recovery is official, the mirror eventually catches up. None of this makes the years in between painless. Daniel and Priya still lose time they can't get back. Years when their retirement accounts should have been compounding, and instead were just clawing back toward even. Millions of families in this scenario retire later than they planned, or retire with less than they'd hoped, or lean more heavily on adult children than they ever expected to. Entire cohorts of workers who were in their 20s and 30s when the long downturn began end up permanently more cautious about investing than the generation before them. the same way people who lived through the Great Depression famously kept cash under mattresses for the rest of their lives, distrustful of banks and markets even decades after the crisis had passed. That kind of scar tissue is real, and it's one of the most underappreciated costs of any prolonged financial collapse. Not just the money that's lost, but the confidence that takes far longer to rebuild than any index ever does. Still, when Daniel looks back on it years later, once the market has finally unmistakably turned and his accounts have started climbing in a way that finally outpaces the losses, what stays with him isn't the number on the screen at the bottom. It's the realization that the thing everyone feared losing, the market itself, was never really the thing that mattered. What mattered was whether people kept believing it was worth building something new, kept starting companies, kept going to work every day trying to solve problems, kept having children and planning futures for them. Even during the years when the evidence on their screens seemed to argue against all of it, the market didn't save them. Their own refusal to stop building, multiplied across millions of households doing the same thing at the same time without ever coordinating it, is what eventually saved the market. There's also a global dimension to this that Daniel only half understands while he's living through it, but that becomes obvious in hindsight. American markets don't crash in isolation anymore, not in a world this interconnected. Countries that had spent years building export economies around American consumer demand, and pension systems and sovereign wealth funds around the world that had quietly parked huge portions of their own citizens' retirement savings in American equities, because the United States had, for decades, been the most reliable long-term compounding machine on the planet, all take the hit at the same time. Emerging market currencies, which tend to get punished hardest whenever global investors get scared and rush toward the perceived safety of the dollar, come under enormous pressure. Countries that borrowed heavily in dollars during the good years suddenly find those debts far more expensive to service in local currency terms, a dynamic that has triggered currency and debt crises in Latin America, Asia, and elsewhere multiple times over the past half-century whenever global risk appetite disappears all at once. Global trade volumes shrink as companies everywhere pull back on expansion plans, which, in turn, slows growth in exactly the export-driven economies that were counting on steady demand from wealthier countries to keep factories running. It becomes, in other words, exactly the kind of self-reinforcing global slowdown that economists warn about but rarely see play out in full, because usually some part of the system, some central bank, some government, some sector, manages to break the cycle before it spreads this far. In this scenario, nothing breaks the cycle quickly, and the pain radiates outward in every direction at once. Back home, the psychological data tells its own story, and it's a story economists watch as closely as any stock index, because consumer psychology is itself a leading indicator of where the real economy is headed next. Consumer confidence surveys, the kind that ask ordinary people whether they expect their own financial situation to improve or worsen over the next 6 months, collapse to levels not seen since the depths of prior recessions. When people stop believing the future will be better than the present, they change their behavior in ways that become self-fulfilling. They delay big purchases like homes and cars. They pad their emergency savings instead of spending on anything discretionary. They postpone having children or buying homes, decisions that ripple outward into construction, retail, childcare, and dozens of other industries that depend on people feeling secure enough to commit to the future. Daniel and Priya find themselves doing exactly this without even fully deciding to. The kitchen renovation they'd been planning gets shelved indefinitely. The idea of a third child, which they'd been quietly discussing before the crash began, quietly stops coming up in conversation. They're not making dramatic, panic decisions. They're making small, cautious, perfectly reasonable ones. The same small, cautious decisions being made in millions of households at the same time, which is exactly how a slowdown in individual confidence becomes a slowdown in the entire economy without anyone ever announcing that it's happening. What eventually breaks the spell in Daniel's story isn't a single dramatic turning point, because real turning points almost never are. It's a slow accumulation of small, boring, unglamorous signs that the underlying economy has quietly stabilized even while the mood around it is still pessimistic, which is itself one of the oldest patterns in market history. The bottom of a real recovery almost never feels like a bottom while you're living through it, because sentiment always lags reality by months or even years in both directions. Freight volumes stop declining and flatten out. Credit standards at banks start easing just slightly, as loan losses finally stop growing quarter over quarter. A handful of companies that spent the downturn quietly cutting costs and building genuinely useful products rather than chasing hype start posting profits that surprise analysts who had written off entire sectors as dead money. None of it makes the news the way the crash did. Recoveries almost never do, because slow, grinding improvement isn't a headline the way a crash is. But Daniel notices it anyway, the same way he noticed the layoffs and the freezes years earlier, because by now he's spent years paying far closer attention to the mechanics of the economy than he ever expected to. That's the part almost nobody tells you when they're describing a crash that never seems to end. It's not really a story about charts and indexes. It's a story about whether a society still believes tomorrow is worth working for, because that belief, expressed through millions of small daily decisions, to keep going, to keep spending a little, to keep hiring, to keep inventing, is the actual engine underneath every recovery that has ever happened. History says the market always comes back. What history actually means, if you look closely enough at every single one of these episodes, from 1929 to 1973 to Japan's lost decades to 2008, is that people always come back first, and the market is simply the last thing to notice.